Welcome to a world where smart investments meet timeless wisdom. Value investing isn't just about numbers, it's about seeing what others miss and making savvy decisions. Did you know that Warren Buffett, one of the richest men in the world, credits his fortune to principles found in just a handful of books? That's right. These books aren't just bestsellers, they are game changers. Here's a surprising fact. According to studies, over 80% of active fund managers underperform the market. Yet, value investing legends consistently beat these odds. How do they do it? The secret lies in the strategies and insights from these incredible books. In this video, we will uncover 6 books that transformed the world of value investing. Each chapter reveals unique strategies and profound insights from investing greats. You'll learn how to spot hidden gems in the market, understand the psychology of investing, and even explore opportunities in global markets. We'll dive into the wisdom of Benjamin Graham, the father of value investing, and explore the contrarian strategies of David Dreaman. You'll also discover Joel Greenblatt's magic formula and Jim Rogers' global adventures. Lastly, we'll look at Howard Marks's modern approach to understanding market cycles and risk. Stay tuned as we reveal how these books can change your investment game. Whether you're a seasoned investor or just starting, this journey will equip you with the knowledge to make smarter, more informed decisions. Ready to unlock the secrets of value investing? Let's get started. Chapter 1. Unveiling the Titans. In the world of investing, one book stands as the cornerstone of value investing: Benjamin Graham's The Intelligent Investor. Often regarded as the Bible of the stock market, Graham's teachings pivot on the principle of looking for intrinsic value that others might overlook. This concept may sound complex, but it's quite simple at its core. Buy stocks undervalued by the market. The Intelligent Investor isn't just about picking cheap stocks. It emphasizes the importance of a margin of safety, a buffer that helps investors avoid losing money. Graham famously said, "The secret of sound investment is 3 words: margin of safety." This advice resonates even today, proving that the most fundamental aspects of investing are timeless. Did you know that Warren Buffett, one of the most successful investors of all time, was a student of Benjamin Graham at Columbia Business School? Buffett credits this book with laying the foundation of his investment philosophy. In fact, he calls it, by far the best book about investing ever written. Why does this matter to modern investors? Because even in today's fast-paced, technology-driven markets, Graham's strategies of discipline and patience remain as relevant as ever. It's all about buying stocks like you would groceries, not perfume, focusing on practicality and value, not allure and hype. But The Intelligent Investor goes beyond just individual stock picking. It also stresses the importance of character. The investor's main problem, and even his worst enemy, is likely to be himself. In short, Graham doesn't just teach you how to invest, he teaches you how to think. Now, turning a small investment into a fortune isn't about taking big risks. It's about managing risk. This book arms you with the wisdom to achieve just that. Whether you're a seasoned pro or a novice, revisiting these principles can significantly improve your investing success. Chapter 2. Beyond the Balance Sheet. Next up, let's dive into The Success Equation by Michael J. Mauboussin. This book shifts the focus from pure number crunching to understanding the role of luck and skill in investing. It's a fascinating take because, let's face it, the market often feels like a game of chance. Mauboussin challenges investors to think about their decisions differently. He poses an interesting question: are you a good investor, or just lucky? This question is vital because it forces us to confront the possibility that random chance might play a larger role in our successes and failures than we'd like to admit. One of the key insights from The Success Equation is the concept of process over outcomes. Mauboussin argues that in a world where luck influences results, the quality of your decision-making process becomes more critical than the outcomes. This idea is crucial for value investors who operate in environments of uncertainty and volatility. Furthermore, Mauboussin provides tools to help differentiate between luck and skill. This knowledge is not just academic, it's incredibly practical. For instance, understanding when outcomes are beyond your control can save you from the common trap of attributing good outcomes to skill and bad ones to bad luck, a cognitive bias known as the self-serving bias. To give you a sense of its practical applications, consider how a professional poker player operates. They make calculated decisions based on probabilities, fully aware that the outcome also depends on the randomness of the cards. Similarly, value investors need to approach their investment decisions with a clear understanding of what they can control and what they cannot. Chapter 3. The Contrarian's Playbook. David Dreaman's contrarian investment strategies takes us down a less traveled path in the investing world. Contrarian investing isn't just about going against the crowd, it's about finding value where others see none. Dreaman's approach is rooted in solid psychological principles. He argues that investors often overreact to both good and bad news, creating stock price movements that do not correspond with a company's long-term fundamentals. Why does this matter? Dreaman provides compelling evidence that contrarian strategies have historically beaten market averages. He notes, contrarian strategies work because they exploit a perennial feature of the stock market: it overreacts. This overreaction is what creates outstanding opportunities for the astute investor. One fascinating aspect of Dreaman's theory is his emphasis on high dividend yields. He points out that companies with high dividend yields often signal undervaluation in the market. Investing in such stocks can not only provide a stable income but also position you well for capital appreciation as the market corrects its initial overreaction. But it's not just about picking any stock that looks overlooked. Dreaman stresses the importance of rigorous financial analysis. He advises looking for companies with strong fundamentals, like solid earnings and reasonable debt levels, that have been unfairly punished by market sentiment. Remember, being contrarian doesn't mean simply doing the opposite of everyone else. It means being selective, disciplined, and prepared to be patient. It's about making well-reasoned bets on stocks that have been unjustly sold off, which often requires a stomach for going against the grain. The beauty of Dreaman's approach is in its simplicity and its challenge. It asks you to question the herd and to think independently. This is not just a strategy but a mindset that, once cultivated, can serve you well across all areas of life, not just investing. Chapter 4. The Value Alchemist. Joel Greenblatt's The Little Book That Beats the Market offers a fresh twist on value investing. His approach, known as the magic formula, is designed to be easy to use and effective, aiming to outperform the market by investing in high-quality companies at bargain prices. The formula ranks companies based on their earnings yield and return on capital, a straightforward yet powerful combination. Greenblatt's formula is deceptively simple. Look for companies with a high earnings yield, which shows profitability relative to stock price, and a high return on capital, which indicates efficiency. By focusing on these metrics, investors can identify undervalued companies that are not just cheap but also fundamentally strong. What's particularly compelling about Greenblatt's strategy is its accessibility. He ensures that even beginners can follow it, claiming, "You can be a stock market genius even if you are not that smart," which is a reassuring thought for those new to investing. The simplicity of the magic formula allows anyone with a basic understanding of math to apply it. An interesting point about Greenblatt's approach is its emphasis on the long term. He advises investors to hold their selected stocks for a year, after which they should rebalance their portfolio. This strategy not only captures the upside potential of these picks as the market recognizes their true worth but also minimizes transaction costs, boosting overall returns. The magic formula doesn't promise instant returns, and like any investment strategy, it has periods of underperformance. Greenblatt himself highlights that sticking with the formula during down periods is crucial. Patience and commitment are key, as the market can take time to reflect a company's intrinsic value. Greenblatt's method teaches us an important lesson: investing need not be overly complex. With a clear formula and a disciplined approach, anyone can tap into the alchemy of turning market opportunities into investing gold. Chapter 5. The Global Perspective. Exploring value investing beyond domestic borders, Jim Rogers, investment biker, takes us on an adventurous journey around the world. This book isn't just about investing, it's about seeing investment opportunities within a global context. Rogers' travels by motorcycle across 6 continents offer a unique vantage point, observing economic conditions and market potential firsthand. Did you know Rogers often emphasizes that real investment opportunities lie where others feared to tread? He famously said, "Buy value, sell hysteria." His approach to spotting value in beaten-down markets in emerging economies illustrates a bold contrarian philosophy that has reaped dividends. For instance, during his travels, Rogers identified compelling buy signals in markets that most had written off amidst political turmoil or economic distress. One key takeaway from Investment Biker is the importance of understanding cultural and political contexts when investing globally. Rogers teaches that to succeed in international markets, one must look beyond financial reports and understand local customs, economic policies, and the political climate. This holistic approach is what differentiates a seasoned global investor from a novice. Moreover, Rogers doesn't just focus on stocks. He looks at commodities, currencies, and even real estate, providing a comprehensive view of what it means to diversify internationally. His experiences underscore the potential for high returns in international markets, returns that often compensate for the higher risks involved. Chapter 6: The Future of Finance. In The Most Important Thing, Howard Marks brings a forward-thinking perspective to value investing. Known for his memos that are widely read by investment professionals, Marks compiles decades of investment wisdom into principles that cater to the modern investor's needs. His book addresses the complexities of today's financial markets, emphasizing the need for a nuanced understanding of the factors that drive market cycles. Marx's key philosophy is that understanding risk is as crucial as seeking return. One of his standout quotes, "It's not supposed to be easy. Anyone who finds it easy is stupid," starkly reminds us that investing requires rigor and discipline. He challenges investors to think differently about risk, urging them to focus on loss prevention as much as on profit generation. In this chapter, we explore Marx's concept of second-level thinking. This advanced thinking isn't about the straightforward assessment of value but involves deep, complex reasoning that questions the consensus and looks beyond the obvious. For instance, when the market is overly optimistic, a second-level thinker considers what could go wrong, which is crucial in avoiding financial pitfalls. Furthermore, Marx discusses the importance of market timing and knowing when to hold back. He points out that the ability to gauge market conditions and investor behavior can lead to superior investment decisions. This insight is particularly valuable in volatile or inflated markets, where the temptation to go with the flow can lead to significant losses. Lastly, Marx emphasizes adaptability and the significance of staying updated with financial trends and innovations. In an era dominated by rapid technological advances and shifting economic landscapes, being adaptable is not just an advantage, it's a necessity.